Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for our next topic, Trader Talk in today's market. And I'm your host, Kevin Horner, joining you from a sunny and beautiful Denver, Colorado this morning. Pleased to be joined by my friend, fellow Schwab coach, Barb Armstrong. Say hey to her in the chat this morning. She, of course, will get to questions, comments that I'm unable to get to. But you all know I like to engage with you on these solo Thursday shows, so happy to hear from you. Please feel free to post in the Q&A there for me for the duration of the segment. We go about 45 minutes in total. If you're not already doing so, take a minute and follow Barb and me on X at Barb Armstrong CS and at Kevin Horner CS. And of course, we'd encourage you to make sure you're subscribed to the Schwab YouTube coaching channel here as well. Stay apprised of all we've got going for you. Remember, we give you live content every day from market open until 5 p.m. Eastern. So plenty to get from us on a live basis. And of course, as you mostly know, about 90% of the content we do for you live is archived and available on the YouTube coaching channel after the fact. So make sure you're relying on that channel and the archive there as much as you need, everybody. Okay, let's get to our disclosures and then we'll dive into the fun stuff this morning. So please remember that our conversation here is exclusively informational and educational. We do not make recommendations nor endorsements for a particular process to trading the market here. No strategies recommended either. However, today on our shows, we talked a lot about technical analysis. So this is a component that traders might be looking to incorporate in their decision making. Certainly something that can be helpful in discerning risk factors associated with your trades. And that's one of the things we cover quite a bit in this class. So when we talk technical analysis, we encourage you to remember it as a complementary viewpoint to your fundamental research. We also encourage you to think of technical analysis merely as one of those puzzle pieces to help us make informed decisions. So not to suggest that you need technicals to make your decisions, but rather just if you're working with the technicals, consider them part of your decision-making process. And so with that, we'll remind you of our standardized agenda here. We do take that top-down approach. We will look at the S&P 500, the NASDAQ 100, the Russell 2000, and the semiconductors today. Try to get the lay of the land that way, maybe hit up some sectors, and then I've got some equities that have been upgraded, some that have been downgraded, and some others that are just in the news for various reasons. And on Thursdays, I do enjoy getting to as many of those stocks in the news with you as possible. So we'll spend a good 15 plus minutes or so looking at those individual charts. All right, so let's get to it. Let me bring up Think or Swim here with the SPX right on the jump. Now, of course, we talked yesterday, Mr. Brent Moores and I, about some of this potential for continuation to what's going on with our rally. And you can see those levels that I've set in here. Let's just talk around the levels that we've done here. So I'm going to eliminate a couple of these lines, eliminate my measured move level. You can see that we are in that vicinity of 6,000, aren't we, everybody? 59.75, essentially flat off the open here, but looking to challenge that 6,000 level above us as a potential area for resistance. Now, if you've been watching the entire rally back, then you, of course, have been setting your approach, or rather setting the levels along the way, and that's what we've been talking about by defining areas of short-term support. We, of course, are hopeful. We are bullish in the sense that we think one of the reasons that traders are bullish now, I should say, is that we've made back a major portion of our sell-off. How major? Well, more than 76%, it would seem. If I did a Fibonacci retracement from our peak to our trough here, you'll see that our current price level has moved us through that 78% retracement. And for so many traders, everyone, it's the 50% retracement that presents issues on a rally back. And then subsequently, the 61.8% retracement that can cause issues for the rally and can give it a struggle spot, right? And you'll notice that at each of those two, the 50% level, we kind of paused there. I mean, there's some good green action, but you notice we traded intraday through that 50% here, had to maintain it by getting some insightful or interested buyers on that intraday day on the 30th of April there. And we just kept pushing. And then we got the same thing kind of similar right in here where we consolidated after kind of breaking that level. So I only bring it up because if you've been watching from the peak to the trough, you may have been setting levels along the way and saying, all right, we've achieved this one, raised my stop up. Now we look to the next opportunity. Okay, we've achieved that next level of retracement opportunity. Now we need to raise stops even further. Well, all of that is to point out that once we have moved through 61.8%, many traders that utilize Fibonacci sequences will tell you that we have the opportunity now to move back to the level from which we started the Fibonacci retracement line. So that tells us that after having moved through 61.8%, many traders are starting to target that prior high, and there's nothing from the price action that has shifted that viewpoint. So everything that has occurred in the last 2-3 weeks now, this little consolidation range that we're trying to break out of, continues to remain bullish and instructive for the S&P bulls right here. And as we discussed yesterday, one of the big key components now is, do we get the breakout with some validation, some carry, some confirmation? Do we get 3 closes in a row over the highest high we've made in the last 2 weeks? That might be a consideration for some traders looking for confirmation. Do we get thrown back and need to see the 20-day moving average once more? That's about 100 points, about more like 85 points away from where we are right now. So that's a potential. And many traders subsequently would suggest if we come back, tested the 20 and held in this zone right here where I had that line in from yesterday, if we did, and that makes a higher high, everybody, which a higher low, excuse me, is of course what we would see here, then a lot of traders would tell you that they would expect another attempt to break through the 59.75 area and continue higher again. So again, what I'm getting at is, I don't know what's coming over the next 24 hours of market time, 72 hours, 96 hours of market time. The truth is, none of us do, but what we're trying to discern is where can we set our levels. And some of you are pointing out we're going to be hearing from Broadcom this afternoon. Absolutely. Thank you, Gary, for the reminder. We'll be, I want to look at a Broadcom. In fact, I think they got an upgrade this morning in advance of their earnings. So we'll take a look at that chart. It's been pretty instructive as well. So on the S&P, as usual, my walk-away comment is, and it's not just the S&P, as you all know, it's the NASDAQ, it's the Russell, it's the SOX. Set the levels where you want to take action, right? And know what action you do want to take when those levels are achieved to the upside or broken to the downside. Just have your playbook in front of you and know how you want to take action in the market. There's not much that we can do, because we always remind ourselves that knowing what the market's going to do is very different than thinking what the market's going to do. And all we're trying to lean into are the probabilities, right? And so now that we've talked some about Fibonacci's and we've moved through some areas of importance for us and seen some important tests along the way, the most notable being the throwback here to the confluence of the breakout level, the horizontal white line breakout, the 20-day moving average coincident there with the 200-day moving average and the upward cross, all of which suggests that the momentum remains. Really, in order for a momentum break to occur, we'd probably need to see the S&P back under 5,800 and below the 200-day moving average, and then it would be a wait-and-see scenario, more or less. So we'll see how this plays out, obviously. Plenty of more time to keep an eye on the S&P 500, but I hope you all like looking at it as much as I do. It seems to give us a little bit more clarity as we evaluate the market. So let's look at what's going on with the NASDAQ here, the NASDAQ 100 in a similar bounce back scenario, a little bit more upside in the sense that we've been climbing more speedily. Our rally has been pretty darn substantial here. If I activate my line and just put us to the last trade at 21,733, we've seen the bounce back here at about 31.5% trough to last trade. That's a fantastic bounce back, obviously. And once more, if we incorporate those Fibonacci's, we're going to see the exact same thing, that we have moved aggressively through the 50% level, the 61.8% level, gap moved to the upside, and now we are well through 78.6. And again, it's not to say that we have to break through. We don't know that we can test 22,222, as nice and round as that figure is, but that's the goal here. That seems as though the path of least resistance could be to the upside there, to at least that 22,222. And so does that mean we run into that level and we use that as resistance? Do we find a way to break through? Way too early to know that. Of course, we're going to try and gain a little more clarity over the coming sessions here with a look at the 20-day moving average. Do we get thrown back here? Certainly, there's a bit of a little bit of a rising wedge. Those of you that are in here kind of frequently with us, you all know of my friend Rachel Deshelle, and she and I have been watching the moves we've seen here in the NASDAQ 100, and these rising wedge scenarios typically don't present as an extension of bullishness, but they can carry a lot longer than you think. Commonly, these at areas of resistance can be viewed kind of bearishly, but you would be, if you're a bearish trader, wise to allow a breakdown of this potential bearish pattern at an area of resistance. You'd be wise to allow it to break down first, and that means you'd want to see a close under the brief trend line I've drawn, maybe a close under the 20-day, and even then, you'd be reminded that a pullback could basically be to an area of potential former support. And that might be somewhere in here, just as an idea. So as always, even if you want to play the bearish viewpoint, everybody, know the level that you're targeting. And if you get to the target or you get a little shy of the target and you want to start piecing out of your trade a little bit, that's one way that traders will take advantage of the price action moves they're getting. So that's one way to look at it. And certainly I wanted to give you, as much as I could, the insight that Rachel kind of threw at me earlier in the week and said, hey, this is something that probably bears watching, and she's not wrong. So let's just keep an eye on it here. Let's see if we can extend the rally in the NASDAQ 100 into that 22,200 zone, or if we get pushed back. It may not be a move that we see today, but it might be something we see over the coming couple sessions here today, tomorrow, and we'll see how that goes. Yesterday, Brent and I spent some time on the Russell 2000, and I put a post out there akin to what we're seeing here today. I wanted to talk. I talked about the potential for the Russell to break through this white line. You know what? Let's just clear it all out because I think it'll be a little easier on us all. So the level that we've been wanting to break is basically right here, right? We need to see some new highs. If we can trade through here, we have highs that we have not seen for 3 months. So that would be a really notable development through 2110 here on the RUT. Now, my thought was that maybe, yesterday this thing took a little bit of a breather, right? We've seen the second push into resistance, our first push into resistance back here. A great move, of course, off of the lows at 1730. We got all the way up to this 2110. So we popped about 20 plus, 21% here, almost 22. And now we're just setting up all of those higher lows along the 20-day moving average. And now maybe we need to sideways consolidate or what have you. But I was noting that one thing we didn't necessarily look at for too long yesterday was the 10-year, and the 10-year does keep dropping here. I say keep dropping, but really taking out the 20-day with some conviction yesterday, thought perhaps we might sit on the 50-day. Doesn't look like that's occurring. Maybe we're getting a bounce here in the yield, a little bit of selling down the notes a little at the open, perhaps. It is a potential spot for a bounce from this horizontal support perspective. But my thought was, if the Russell was going to break out, the potential for it to do so could be tied directly to the move in rates. So if yields continue to fall, then that could be optimistic. Two things, right? If yields are falling, it's because strongly we're seeing purchases of U.S. Treasuries, and U.S. Treasuries get bought up, pushes yields down, suppresses yields. When U.S. Treasuries are sold, then we see yields rising. Now, the reminder that I want to offer, of course, is it also speaks to the health of the economy. What are investors in U.S. Treasuries thinking about if they are selling those U.S. Treasuries? Commonly, the thought is they're selling those U.S. Treasuries as a lack of confidence in the U.S. economy. And if they're buying those U.S. Treasuries, then the thought process can lead to confidence in the U.S. economy. And so it's a multi-pronged view, right? If yields continue to fall, then it may give lift to our smaller cap positions, which are largely tied to yields because they are more heavily debt-laden companies commonly, right? Not all of them, but commonly. That's the thought process. So that's one of the reasons that you might witness a breakout here, and it could very well be a very positive development for the broader market if we can get some short-term small cap leadership. It has been a while since we've seen that. And then when you think about what we've seen from the NASDAQ and the S&P 500, with both having cleared their 200-day moving averages, having done so with conviction, having worked almost back to the highs we had fallen from, the Russell is clearly the skunk at the picnic. I'm going to steal one of my man Lee Bull's comments. So, the impressive move here is the 20-day moving average catching up. It is the broken downtrend line for many of this, right? So we could say that we have busted the downtrend line, but ultimately it's all about that 2110 level for us, everybody. Can we get back through there? And then I'll just point you to the weekly candles once more, and then note the levels from which we have bounced and moved. The 2100 has also been, let me just extend this to the left, and you'll see where that lines up. So 2100, very important level over multiple time frames, and a really good reminder of why we look at it. All right. So always consider your time frames, everybody. Make sure you're not mired in the daily chart exclusively. Let's move in to some other areas as we do that. And then the last thing we'll look at here is let's look at the semis. Got a lot of patterns drawn in here as well, everybody. Another one with a vastly and speedily improving chart. The move here that we got yesterday, validating a little bit of a breakout, was carried today. Let me eliminate my measured move drawing here. We'll zoom in a little further. So what do we get? We've had the same consolidation in the stocks over the last 2-3 weeks that we've had in the NASDAQ 100, that we've had in the S&P, and we're seeing some leadership from the semis. Now, we broke out of this range yesterday, and that's why we did the measured move calculation, basically the height of the breakout to the peak. And then we added that to the breakout spot in the hopes of the next target. And it gets us in the vicinity of the last high up there, possibly, 250 plus potential points. But, try not to pay too much attention to the downsloping manually drawn trend line where we may have paused today. That is such a fairly easy way to draw a trend line. But, the times that you find your price action meeting a trend line you drew a day or two prior is not uncommon, but try not to put too much stock in that, because inevitably, a trend line is only as good as the individual who draws it. So let's try not to be lean too heavily into the confidence of our trend line draws. But I think it's more important, and I think a lot of bullish traders would tell you, more important that we've moved through the level and have maintained it to this point. Granted, a little bit of opening weakness here off the jump, but something worth monitoring on the semis at this point. Now today I wanted to highlight two other things that I normally don't get to with you all. So I thought I would show you a chart that I like to use just to set my day up and make sure that I have a bit of an understanding of how we are feeling relative to the S&P. And one of those charts is just a side-by-side comparison of the S&P futures right alongside the volatility index futures. So the VIX futures here /VX on the right, and the S&P futures, the /ES on the left. Now, the thing it's kind of interesting about this, everybody, is the ability to monitor this in a pre-market setting, but also to be able to kind of get some visual on what could be happening live and in the moment. And I'm only looking at a 2-day period here. A 5-day, 5-minute, and I guess I just didn't have them extended. So let me make them full 5 days. So you see, where are we on the ES here? Okay, we are pulling back, and we are seeing a little bit of short-term weakness, but really the lowest lows we have seen since the rally pushed aggressively from Tuesday morning. And so we're wanting to see, can we hold up here? Probably looking at the futures trying to hold on to S2 here. I wonder if we did a little Fibonacci from this move to this, would we find that this lines up? Well, there's the 50% level. That's not all that uncommon to see. Fibonacci is just as a reminder that 50% is not a big reason, or it's not a part of the Fibonacci sequence, but it is a level to which many traders expect rallies to drop to, giving back half of a given move. So it can be instructive or insightful. And if we did something similar here on the VIX futures move from the peak to their recent bottom, you can see that the bounce just went to the 23% level. And so, some traders like to put this side by side, everybody, to give you a visual confirmation of price action. I find it to be notable or maybe a little helpful in the pre-market. I do find it interesting that the Fibonacci we drew from the low on Tuesday AM to the peak we made this morning retreated to exactly the 50% level. Doesn't mean that has to hold, but I'll tell you, if you're watching the ES, that might be a very short-term structured level for bulls today. Staying above that level could be important on the ES. So one thing to keep in mind. All right, we are going to get to a few of those things. Yeah, I wanted to mention the VIX, of course, for you, Carol. Guys, we will get to a look here briefly in gold and silver. And I want to answer Joe's question about the pivot points. Joe, that's simply a study we can add. Studies are added via the flask or the beaker here. And all we need to do is you can start typing in pivot here, PIV, and you're going to find it right there. So when you double click, it gets added. And then you click on the gear to assign some width to each of these lines. You'll move through. By default, R3 and S3 are not check marked for the show plot. So if you wish to see those, you'll want to put a check mark there. And you'll notice that mine are set to numerical, and that's what gives me what appears to be the flat line in my pivot points as opposed to a dotted line. When I have them set to auto, I get a dotted line. I prefer the flat line. The only other thing you might know about mine is that I ask it to only show me today's pivot point action. I don't want to see the prior day pivot point action carried across my chart. So that's one of the changes that I've made there. And I do that pretty consistently, not just on this ES versus VX look, but if you pay attention to this class frequently, or you watch me navigate through my short-term price bar action, 5-minute bars, and so forth, you'll see that I've got those added in here as well. So that's how you get them added. They can be helpful as potential short-term support, short-term resistance scenarios for some traders. But not everybody works with the pivot points, but if you pay attention to the market intraday, they can be quite notable and can be helpful. So, all right, well, there's our look at things. The only other, let's see, you know what? The other thing I thought we could check is just I'm not here to tell you that everything is bearish or everything is bullish. That's not what we're doing, but we are looking at various details. And one of the other things that I thought we could check on is Dow theory here. And so Dow theory just gives us the chance to look at how the Dow Jones Industrial Average on the left is reacting or acting, alongside the Dow Transports. Now, this is a theory that has been in play for a very long time, I should mention. Ultimately, this is something that was developed by Charles Henry Dow back in 1880s and 1890s, and his job then was to try and understand the relationships between these major groups and how we can utilize these to our benefit. So when we look at the comparison between these, first of all, I'm going to make sure that my study sets are accurate. So let me put on my period SMAs. There we go. So those are my weekly simple moving averages on the Dow Jones and transports here. And then over here, do the same thing on the industrial average. There we go. So the big thing that I can note here, everybody, is you could pay attention to the uptrend line that remains in place on the Dow Industrials. But on the transports, that uptrend line has been broken, okay? And we're watching that green downsloping 20-week simple moving average because we've failed at it now for the last 4 weeks. Very important level to get above. But ultimately, the thought on, as it relates to Dow theory is What we want from a bullish market is one where industrials are moving upward in the trend, and you're getting the same confirmation pattern out of the transports. And the transports are commonly thought of as a leading indicator because of what they do. They traditionally move product into and across country. And when we see transports dropping like this, it can be a bit of a heads up. It is notable that they both made the move at the same time, but the industrials maintained the trend, whereas transports have broken the trend. So it's not a great setup in this regard, but it might not hold as much water as it once did, simply because the economy from the 1890s into the early 1900s is vastly different than it is today. And I say this all the time, that the relationship between the industrials and the transports might have lost some steam, but that does not downplay what could be super important about this relationship. Now, if you want to be a little bit more into the current market scenario, one thing that some traders might be looking at could be the comparison between the S&P 500 and the semiconductors, because we know the relationship here is so important. And when you look at these two in a side-by-side relationship, well, we see that we have had an uptrend that was pulled back to a major area. Both are getting significant bounces. Not either has made new highs as of yet, but they are bouncing. So, there's some improvement here. The big thing from the SOX, I think, let me draw the trend line in on the SPX there. And then on the SOX, I'll draw it in as well. I think the fact that the SOX spent the last month getting back above that trend line is as notable as anything else. Pretty big difference there from what we saw with the transports just a moment ago, right? The biggest difference, this 4-week action in the SOX is above the trend line. The same 4-week action in the transports below the trend line. What does that mean? I don't know, to be honest. I don't. But I felt it was something that we could look at and it might offer more insight. So I just wanted to bring that up, everybody. So let's move off of that and let's come back to talk about some of the things you all are interested in this morning. So we heard, I saw that there's some big moves here in some commodities. So let's hit up. We'll look at gold real quickly here. Not going to dabble, but you can see the price action we've been talking about, the very casual stair-stepped approach. You don't necessarily need that 20-day moving average, do we? Let me bring in my cheat tool here, everybody. Let's just let's look at the 50 here. Look how pristine the 50 has been for you along the way. That might continue, that might not, but our last bounce off the 50 has pushed us right back into the resistance band here. And so potentially we are looking for a breakout here in gold after yet another test of the 50. If we get a breakout in gold, the measured move might be 3,200 to 3,500, or 3,450. So call it about a 250 potential point breakout. And if you added 250 to 3,450, that gives you about 3,700. Again, by no means is that a lock to occur, but you do have a bullish trend and a bullish range playing out, and a break to the upside through 3,450 would be significant on gold. So that we will check on and keep a close eye on for you. And then silver today is making the big push. Now, the reasoning behind it, I'm unclear on, I will be perfectly honest, because I've not had an opportunity to do a whole lot of silver homework this morning, but the move itself is the key development here, right? If I extend my former resistance line, and maybe I'm going to have to edit this now, everybody. Let's just do it. Let's make it green. Look, we might be in the midst of a very strong breakout here. I'm going to activate my trend line, and we'll point out that, yeah, basically we're looking at a range from 35 down to 29. So you're looking at a potential 6-point range. Could give you $40 on potentially here on a breakout like this in silver. Again, we don't have to be terribly knowledgeable about necessarily the reasons, but we do want to pay attention to the action. And the fact that you've seen silver move to new highs, highest highs of all time, that is not a bearish look, is it? So that's one way to think about it. Again, bearish, new highs are not bearish as a common thought process. All right, saw some other requests about home builders. Before we get to home builders, let's just peek in on Bitcoin while we're here. Bitcoin seemingly setting up at the former area here of resistance. Now, this is not tied to the 50-day. Let's bring my cheat tool back in here. Let's add in my 20, 50, and I bet the 20 is what we're sitting on there. Yep, sure enough. So there's your 20, everybody, sitting right on the 20-day moving average here, a spot where a lot of traders would look to deploy and add to a potential move here. But notice we are below it in the short term. So we are sitting on a pretty important level. Now, in one of the recent classes that I've talked about of late is looking at these over longer windows of time and trying to incorporate patterns and moving averages over shorter term windows that could be helpful. That green one we're sitting on here is the 137 period exponential. No, that is simple. I'm sorry. This I thought was exponential. It is simple. 137 period simple moving average. And so what that means is that is 137 4-hour blocks. Okay. 137 4-hour blocks gives me 34 4-hour blocks. And we have on a traditional market day, we get, let's see, my math says 61%. Or 1.61, excuse me, 4-hour blocks per day. So gives you an approximation of about 137. I should have done this math in advance. There we go. So it's about right around a 50-day simple moving average. Nope, that's not right. Right around the 20-day simple moving average, excuse me. So what you can do is incorporate these short-term levels as on your intra-period charts can be used to kind of help out a little bit. Like I said, I talked about this, let me think which class I did last week where we were diving into this. It was advanced, I think it was advanced charting where we talked about this. I actually went a little bit more in depth over multiple windows of 5-minute bars, 1-hour bar, 15-minute bar, etc., just to give you some insights on potential ways that traders might use shorter term periods with different moving averages that line up with some of the daily traditional moving averages. And the only reason being, everybody, is moving off of your daily chart into your intra-period chart can give you some insights as to whether or not the ledge you're watching on the daily chart has any option of holding in the interim. And if the short-term opportunity doesn't stick, then some traders start to tighten their purse strings a little bit intraday. Now, that doesn't mean that everybody navigates that way or that everybody should. It's just another way that if you are looking to maybe make decisions quickly and in the moment a little more speedily, doing so over 5-minute bars into 15-minute bars into 4-hour bars, etc., can give you a little bit more insight. It can also give you too much insight. So, know who you are as a trader, know what the things that you like to pay attention to. Not everybody's going to want to pay attention on a very short-term basis. Okay, let's just a quick look here on the 5-minute bars one more time. We're going to peek in on the S&P. Okay, our pullback came right to that S2 level here. So we tried to open favorably at the peak, did not, so we got a bit rejected. Notice that upsloping period moving average, that is my white one here, is the 390 periods. Now that on a 5-minute bar is going to be a little bit more easy to figure because we get 12 5-minute bars an hour, and we do that for 6.5 hours a day. And that means that we have 78 5-minute bars per day. And so the white line here at these 390 periods, 390 5-minute periods, that is akin to the 5-day simple moving average. So this is an exponential moving average on my intra-period chart, but Just understand, this is basically the 5-day simple moving average line, right around 59.45. And some traders might look at that because, simply put, that's a lot of momentum-based support, if you will, even if we didn't break through. Even though we pushed right to the same highs we have seen, failed, rolled back, this is an area where some traders would say, okay, we've given it back. Let's see if we can get a bounce. So just wanted to bring that up. All right, let's get to some of those stocks in the news I mentioned, everybody. We've got a couple of upgrades. We talked about, I mentioned Broadcom, so let's pull up Broadcom. We see here we've got a stock that has managed to continue breaking out. We broke a downtrend line a while ago, and the excitement behind that has been terrific. You'll notice that the gap and go move was right available to you. You got a bull flag over the next 2 weeks, and that got taken out with more conviction. So the 20-day moving average is there to work with, everybody, but is it too slow? If you want to be a well-defined exit strategy trader, you might want the 10-day moving average. Look at where that lines up. That's still 15 points away from where we are right now. Yes, we have earnings after the market tonight that bear watching, but you've been above the 10-day now, all the way back here to April 23, with one deviation beneath it as it was in the midst of forming that bull flag. So, this is a bullish chart to be sure. The question is whether we can maintain that bullishness post earnings. Now, Erste Group is the analyst group that upgraded Broadcom. They did upgrade from hold to buy, stating that the company has an attractive product portfolio for network applications, and its operating margin and return on equity are significantly higher than competitors. So that's the reason for their upgrade. We do not have a price target on that. Got an upgrade as well in Visa. Seems kind of notable here, given that Visa's at, once more, all-time highs. Mizuho analysts upgrading Visa to outperform from neutral. Target, though, provided here up from 359, now at 425. 425 would be a fantastic development. Obviously, price targets are not guaranteed to be achieved, whether they're analyst price targets or your measured move price targets, but very important to pay attention to nonetheless. The nice thing about such a target, if we're talking about where we're trading right now, that would be about a 55 point upside, and that would put you about 15% premium from where we are if it were to get there. So a lot of traders will point out on the Visa look here, downtrend break, short-term quick consolidation, followed by continuation, throw back to the 20, more hold of the support along the 20. We've been above the 20 here since April 23rd. That's also coincident with when we saw the same thing in the S&P and the NDX, both. April 23rd was when we recaptured the 20-day moving average. So this has been playing along the same vein as the broad market. And a lot of traders like to trade with stocks that kind of track the rest of the market. Just makes things a little bit easier. But by no means does that guarantee anything. We know that. See the note here from Eureka. Let's just quickly look. Why not? Let's just look at those last few earnings reports. I'll see if I can snap a vertical line. Guess I'll have to draw it in here. So we have earnings from back on the 6th. Well, it did hold its own for a little bit, right? But it did break down eventually, so that bears watching. The earnings prior to that led to a pretty significant gap up right to here. So we had been trading through into resistance there, and then this earnings hit, and it led to a substantial move from 185 all the way up to that, what was at the time a new high of 250 before pulling back. So I'm not sure that we can assign any true consistency on Broadcom's reporting leading to bearish moves. But many traders will tell you that after a significant move like this, from the lows to the peak, and that move is good. When we're talking significant, everybody, that's 91% we have seen since the April lows in Broadcom. Would it shock anyone that we get a pullback or a profit-taking move post earnings. My hope is that your answer is no, it wouldn't shock me. So be prepared for such an opportunity, everybody. If you are long. So with Broadcom's potential having made this dramatic move from the lows to the last trade up more than 90%, some are going to look at this as their opportunity to just pat themselves on the back, maybe take some profits, but know what is your preference, everybody. I got to tell you, I don't think there's anything more important than recognizing your personal risk tolerance as it relates to this. The odds are obviously strong that you're in a profitable scenario with a stock trading at all-time highs like this. So please make some decisions in advance of the earnings that could help you to protect it, whether that be through potential option strategies or just trade plan management. Either one would be advisable after such a significant move. It's not to suggest they can't have fantastic earnings that support this move, but recognize that the speed with which the stock has accomplished the return that it has in a very tight 2-month window, that's an incredible return percentage, and a lot are going to look to take some profits at some point. So just be prepared, be aware. Okay, there was another upgrade that I wanted to review, and that's in Dollar Tree. The dollar stores and the dollar grouping here, Dollar General, Dollar Tree, looking pretty intriguing of late, everybody. We've noted having moved through a pretty important area. So that first area was right in this zone, bottoming pattern, bottoming range. So what I drew in was something kind of like this. This is let's call it 61. And this is 77. We're looking at about a 15, 16 point opportunity. 15 from our 77 would get you 92. And boy, we're right up there already. So some would tell you that we've already achieved the so-called measured move from the range that we traded in here to the potential upside. Now, does that mean that this has to stop in here? Absolutely not. We can notice that if you're a trend trader, that 20-day moving average is in play again. Why do I say that? Well, look at the candle we got just yesterday, everybody. Again, a candle that closed on the 20-day moving average after having been beneath it on an intraday basis. So that seems notable to many bulls as well. And if today is going to stay green like it is, then today could be the close above the high of. So sorry with my technicals here. Everything seems to be I don't have a good answer for you because I'm the only one doing anything in the house at this point. So it seems my system details are just causing me some issues. So let me just give you these. Last three I want to hit are downgrades, and I'm not going to have a chance to do any real price action or review, but Erste Group did downgrade Salesforce to hold from buy. Would have appreciated a little bit of a downgrade, heads up, maybe 100 points ago. That would have been helpful. This one's been undergoing a bit of a retracement under the 200-day moving average. Chewy also got downgraded today by Jefferies, downgraded to hold from buy. Now, this is something that I can understand. Again, you had an excellent move to the upside. It is a bullish chart. Trough to peak, we're seeing a 60% rally. Chewy, the Jefferies analysts are stating a new target at 43, up from 41. The firm says that while the pet macro environment looks stable, Chewy is performing well. A change at CFO is underway, and the shares already reflect the positives from this change. So Jefferies sees limited upside to the numbers beyond the high end of the guidance at this point, and they are downgrading it based on valuation, everybody, which does stand out. Okay, I'm going to be forced to wrap it up there, everyone. I'm sorry I don't have more time to devote today, but I feel like we covered quite a bit today across the board. Our major indices, we looked at some of those commodities. We got to hit on gold and silver as well as Bitcoin. We looked at the relationship in futures earnings, futures on S&P alongside VIX futures. We looked at Dow theory as well. And then we got to stocks in the news, some upgrades, a few downgrades. Busy day, but much more to come from us right here on the channel, of course. So keep it tuned right here, everybody. I want to thank Barb for being here and joining me. You can follow us on X, Barb Armstrong CS, Kevin Horner CS. Trying to get some more individual chart posts out there for you, everybody. So take a look at the profile there for me. You'll find a few recent charts that might be notable. Some pretty interesting stuff going on in the market these days. So some fun discussions to be had. So thanks for being here. Thanks for participating in this segment. Follow us on X. Hit that thumbs up button down below for me if you don't mind. That'll help us out when we get this one in the archive for you very shortly. So have a great rest of your Thursday, everybody. I look forward to seeing y'all again real soon.